The everything bubble collapse, including silver and gold. So is the everything bubble about to collapse, including gold and silver? Well, before we look at trying to answer that, let's just cut to a short clip from a recent interview with Kyle Bass.
Okay, let's talk about the market implications for this and what investors should be thinking about with all of these concerns you just laid out. What would you tell somebody who's trying to figure out where they put their money? By the way, given this backdrop of the market collapse that we're watching too.
Yeah, so I have bad news for you there. My view is you have, so far, you have 30 trillion of global stock market wealth has evaporated since the higher inflation prints and the aggressive Fed speak, as you know, talking about aggressively raising rates concurrently with shrinking the balance sheet. Well, Becky, they're just beginning to shrink the balance sheet now. They're going to take 100 billion of risk assets out of the market each month from now on. Just think about the implications of more aggressive hikes concurrent with $100 billion worth of risk assets being removed from the market for months to come. I can tell you this, the stock market will not go up in that time frame, right? So I think the investors and financial advisors need to not be buying dips right now. I think that you need to let this play out. I don't know how much lower the market's going to go, but my own inkling is that, our belief is that the Fed's not going to be able to pull $1 trillion out of risk assets, even though their balance sheet is north of 8 trillion. I don't think they can I don't think they can go 10 months at 100 billion a month or 11 months before the stock market's down another 30–40% from here. So I think
30 or 40% from here. That is a really big drop.
Imagine if they raise, as they hike, this week they hike, next month they hike, November, and all at the same time they're pulling 100 billion a month of risk assets out. Becky, the market is going to absolutely convulse when that happens. And I think the Fed is laser focused on arresting the inflation problem, and they're not necessarily concerned with what's happening to the stock market. And I think that has a lot to do with what happens as we go into November. So, Becky, I think between now and November, things are going to materially worsen. And so when I think about where to put money today, I would wait until you see the Fed start to use the word pause more often and say, maybe the market's dropped enough. Maybe 30 trillion coming out of investors' pockets is going to have a severe chilling effect on global markets, which it will. It just takes time. So I think that a lot of their job is actually already done. I think inflation I think you're going to see food and energy prices continue to head higher unless we have a massive recession. And I think we're going to have in North America or the US, I think we're going to have a brief recession or a shallow one. Europe's going to be a little deeper just because they have such a problem with their energy supply chain, and China's having its own problems. So I think you're going to see markets go a lot lower going into November.
All right, so some of the charts I'm going to share with you are from across the globe. So we've got some news from the UK, the US, New Zealand, and of course Australia. So here we've got New Zealand housing inventories and median days to sell. And have a look at that. And you guys know from previous videos, the New Zealand market is falling faster than the US did in the first 6 months of the global financial crisis. And in the US, we have now seen home listings inventory finally rising. So are people now starting to sell their homes? Are interest rates starting to bite? Well, keep a close eye on this one. And in Phoenix, Arizona, now has more homes for sale in 2022 than it did at the start of the cerveza sickness, with a 125% surge in inventory in just 2 months. So once again, buyers are leaving and sellers, well, they're beginning to get desperate. So let's see how this plays out. And also in the US, listings with pending sales is now minus 16.3%. I would argue, based on the last two charts alone, that US housing is in trouble. And as you guys know, I have been selling most of my real estate in the last 12 months, a little bit over 12 months now. So I found this a very interesting chart. So we've got house price index versus owner's equivalent rent. And you can see the recessions in the grey lines. Well, the spread between these two housing price indexes peaked in January 2006 at 40.1%. After the bubble, the spread narrowed to 2.6% in October 2011. And right now, it's 63.2%. So there's a lot of talk that the US housing market is in a bubble. However, to all my American friends, you guys, you want to see a housing bubble, check out Australia. Here you can see a chart. So US median house versus the median income, you're looking at 5.8 times earnings or 5.8 times income to buy the medium house. And in Australia, we're at 10.5 times. So, yeah. And speaking of Australia, so Digital Finance Analytics latest data regarding mortgage stress. And mortgage stress is defined as on a cash flow basis, so cash flow in versus cash flow out, is now at an all-time high of 45.2%. And the RBA hasn't even really got started with their QT and raising rates. So this is all due to the debt bubble. As rates over the last 40 years, we've had this bond bull market, and as rates have just continued to get lower and lower and lower, it increases people's purchasing power or borrowing capacity, should I say. And what have we seen? We've seen an increase in debt along that way. And it's not just household debt, corporate debt. We've now got a big sovereign debt bubble, which I'll kind of come to at the end of this video. And check this out. Check this chart out from Alan Kohler on his finance report on ABC last week. Household debt to income ratios. Even going back to 1990, Australia had one of the lowest debt to income ratios in the world. Now, we got the gold medal. And the world knows that we've got the debt bubble. In the UK, number 10 considers a 50-year mortgage that could pass down to generations. Because we can't allow the housing market to crash, can we? Because they know raising rates to fight inflation, they're going to pop the debt bubble. And that is going to, and I've said this, if they raise rates to where the market is predicting, and the market's actually cooled off at somewhat, if you've seen a recent chart of 10-year bond market, 10-year yields, futures market, yeah, the yields have come down quite a little bit. So, other markets now sensing that central banks will not raise as high as they previously forecast, because they know if they do, we're going to have the biggest depression, that we've ever seen in our lifetimes, but probably make the 1930s look like a walk in the park based on our debt bubble. So I do expect governments and central banks to ultimately, once there's been a bit of pain, and like Kyle Bass said, just hear the words, pause, pause, pause. As pain kicks in, and there's a political issue here, as pain kicks in, will they pause, will they reverse? And at that point, and I'll come to this at the end of the video, there's a particular asset that you want to own, and that particular asset, it's been beaten down of recent times. And the stock market, well, how's this? Operating earnings are forecasted to almost halve. And input costs have just eaten into corporate earnings. So this is not good news for the stock market. Really, no matter what interest rates happen. No, come to where I see the stock market going and whatnot in a second. And for all the talk that the household, and we've got some economists here in Australia, but really around the globe, there's this push to say, well, households have never had more savings. They've never been in a better position. Well, from this chart, from this Fred chart, real personal consumption expenditures, I think this chart speaks for itself. So the one thing investors need to be very, very careful of is periods where we have lost decades. So, yeah, we have market crashes, we have bear markets. I've been banging on about 1973-74 being a similar style event, and I'm hearing a lot more people now starting to talk about that and bring that up as a comparison. I've been talking about that for some time now. And, one thing that I think the stock market, the overall index, it's going to be, we could see a lost decade. So we could see a market correction like we had either, a crazy one like in 1929, but even in the 1970s. So having like a 1973-74 style event, and with high CPI adjusted for in real terms, I don't see much gains happening in the stock market and in the overall index. So if you just invest in the Dow, the S&P, or here in Australia, the ASX 200, it's not financial advice, but you've got to be careful. We could have a lost decade ahead. So investors need to be very careful how they allocate their capital in the stock market at the moment. And coming in from Australian Broker, most Australians opposed to rapid interest rate rises, with just 39% of Australians support the RBA's decision to lift interest rates as hard and as fast as it has recently, new research has found. And as much as I argued several months ago that central banks would raise interest rates, not because whether economics makes sense or not, but because of political decisions, because inflation hurts the majority of voters. And so politicians will be quick to point the blame at others, and they want to be seen as tackling inflation for political reasons. And just as much as that's going to be, all about politics, the pause that Kyle Bass talks about, and then the pivot will also be political, because the amount of debt that people are holding right now, this debt bubble, well, these interest rates are going to hurt. So they're going to hurt just as much as inflation. And so at some point, it's going to become a political decision where central banks and governments will be forced to pause and then reverse course. So, and at that point is when I believe we'll see the explosion in the metals, because I think the release point. So they'll then try to save households, save the corporate sector, and obviously then there's the sovereign as well. And at that point, it's the currency is going to be that release valve, in my opinion. And we can already see it with the cash rate futures implied yield curve, which has flattened considerably over the last month, where we did see at one point that the market was predicting the RBA interbank cash rate to be above 4%. Well, now it's peaking at 3.545 in June next year, and then it then falls away. So the market's expecting rate cuts, and that is that pivot. And like I've been arguing about this 1973-74 style recession, asset price falls, and then the mid-70s kind of went sideways there for a little bit, especially the metals. But then when CPI really roared back, when the currency, people were losing faith in the currency, aka Carter bonds, that's when we had this huge spike in both gold and silver, and so that's what I think we'll see again, and so that's how I'm positioning my portfolio. And I thought I'd share this chart, S&P 500 in ounces of gold, as a reminder. For me, I measure my gold and silver in other assets. I don't measure it in dollars, in fiat. I use wealth cycles. I've done videos on this. I've shared my own personal story about using wealth cycles. So these are charts that I keep an eye on. I have a look at, S&P 500 in ounces of gold. I look at house prices measured in gold, and I've shared in other videos Sydney house prices measured in gold and whatnot. So my opinion, I think asset prices, risk assets have got a lot further to fall. I still hold true to that 73-74 style event. It won't be exactly the same, but I think it's rhyming. And so I do see asset prices falling a lot further as central banks continue to raise rates. I think, personally, silver is very close to bottoming. I really like silver at these prices. Gold has done well. Gold has really held up in the face of what we've seen. So gold is really proving itself as that sound store of value, that store of wealth, that safe haven asset. And it's why I've talked about the Dragon portfolio, Chris Cole's Dragon portfolio, and I did a recent video about that and how you want to have a percentage of your portfolio in gold, and how it helps your portfolio over the long run. And gold is definitely doing its job right now. So personally, I see silver very close to bottoming, and I like it at these prices. Now, I'm going to do a video, probably my next video, where I'm going to give you guys, I haven't done this on my channel before, where I actually break down my portfolio and how I invest, and you'll see my strategy and all that sort of stuff. And I can tell you right now, I've been building up cash, and I've shared this on in other videos. Yes, I'm holding a percentage of my portfolio in US dollars. It's still there. That hasn't changed. I haven't pulled the trigger on that yet. But I did share earlier this year, I started trimming my positions and building up some cash. Well, I can tell you guys that I have been redeploying those savings and that capital into a lot of silver, juniors, explorers, developers, and also some gold producers and developers and explorers as well. So I am starting to jump back into the market, because if you have a look at these gold and especially silver stocks, and especially in the junior space and in the exploration space, they have absolutely been beaten right down, like dirt cheap. Yet, here's the thing, their intrinsic value. So I'll give you an example. There's a stock that I own that has an intrinsic value at over $1 a share. Well, it's been smashed down to about 17 cents. So guess what? Buying it. I actually bought it. I think my buy price is about 36 cents. So I actually went in and bought more of it, because the price has changed. The value hasn't. The value will be recognized. And as Warren Buffett says, if you buy a stock at $1, you better love it at 50 cents. Well, guess what? Most people would hate this stock if they bought it at 36 and it's down to 17. By the way, that stock actually did touch $1 in August 2020. They would freak out. Me? I just said, thank you, Mr. Market. It was last week in the office. I bought it at 17 cents. I said, thank you, Mr. Market. I don't mind volatility. I don't mind when markets crash. I buy put options and short on the way down. But there's a difference between price and value. And so in my next video, I'm going to talk more about how I invest and the different strategies that I have and how I allocate my portfolio. And I'm going to go into a little bit more detail than I ever have done before on this channel. So is the everything bubble about to collapse? Well, I think housing is in some real trouble. I think the stock market has got further to fall. Silver, I think, is close to bottoming out. And gold and silver stocks in particular have been smashed down, especially the juniors have been smashed down to bargain base level prices where I think, they're well under their intrinsic value. And I'll talk more about that and especially how I invest and look for value, because I look at it in a couple of different ways. So stay tuned for that video. But that's my opinion. What do you guys think? Is the everything bubble about to collapse? How are you guys investing? Love to see your thoughts and opinions in the comments below. Once again, if you like this video, guys, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.